Hello, everyone. Welcome to, and I'm coming to you all here from my hotel room in Osaka, Japan. And I've been getting plenty of messages from viewers asking me about central banks like Turkey, which are selling their gold to buy their local currency, asking me if this may signal the end of central bank gold buying and, as a consequence, the end of the gold and silver bull market. Now, what's important to understand here is that Turkey is selling and often swapping gold with the intent of buying it back later to buy its local currency, the Turkish lira. And they're doing that to create demand for the currency and drive the price or value up relative to the US dollar and relative to oil to prevent the currency and the economy from completely collapsing in what one may call a mirror image scenario of what we saw in 2008 when large private US banks were running out of money and facing bankruptcy as a consequence of bad mortgage loans. During which time, in cooperation with bullion banks, they raised money to avoid bankruptcy by selling gold and silver, which led to a major price correction that you see on the screen right here. That said, in 2026, this action that has many gold and silver stackers concerned is clearly telling us two things. Number one, that gold, which is an appreciating asset, meaning it goes up in value over time, as opposed to the US dollar, which goes down in value over time, is liquid enough or easy enough to sell in times of need to support a local currency, that it not only acts as a store of value for nations, but also as a store of liquidity in times of need, which in layman's terms just means that despite many people saying gold can't replace the US dollar as a reserve asset, Turkey is proving that it can, which is strengthening the central bank case for owning gold as a reserve asset. It's not weakening it. Number two, this action reveals who is in trouble this time around. With private banks like JP Morgan backed up and guaranteed by central banks like the Federal Reserve, who are ready to print up paper money to bail them out, like we saw in 2023 with the Bank Term Funding Program. The real issue isn't those private banks or even so much their private credit problem, although it is a problem today. In 2026, it's sovereign countries like Turkey and Japan that make up a portion of more than the $100 trillion global sovereign debt market that are the problem. And as a result, they are being forced to sell assets like gold, as in the case of Turkey, to prop up their weakening currencies. But unlike in 2008, when they could print up the money to save the private banks, the ones printing the money, or who print the money as a simplified way of looking at it, are the ones that are in trouble this time around. The chickens are coming home to roost, as we say, with the next big step being a major sale of U.S. bonds and U.S. treasuries, which has already started, by the way, with Turkey, the same country that has sold some of its gold, reportedly dumping more than $20 billion worth of U.S. bonds since the start of the war with Iran, which is more than the $7 billion in gold that they've sold outright, which the media conveniently doesn't talk about at all. And this has the potential to trigger an outright crisis that threatens the stability of every fiat currency around the globe. No real exceptions this time around, with the only safe haven being gold and silver, which in my estimate still have a 2009 to 2011 style boom still ahead of them. So in this video, I discussed the situation for gold and silver, as well as other commodities like copper and oil, with Michael Oliver of Momentum Structural Analysis to discuss what comes next for gold and silver. We also discuss why he thinks I am being too conservative with my price targets, especially my $150 to $200 an ounce price target for silver. And we also discuss how people should approach a portfolio right now. If it makes sense to buy oil stocks right now where they are or wait for a pullback, and how much of the oil stocks you should hold relative to mining stocks for people like me who have built their stock portfolio in that way. Now, just before we get to the conversation, I want to remind everyone that for me, Summit Metals is the absolute best place to go for gold and silver online. Whether you are a buyer or a seller, you can be sure you will be treated right on both sides of the transaction. You can find them at summitmetals.com. Their prices are great. All products are verified as 100% authentic. No scams, no fakes, and sellers can sell with confidence knowing they're getting a fair price. And if you're new to Summit Metals, please remember to get your 3 ounces of silver at spot limit 1 per household, and I'll leave the link to this deal in the video description below. And without any further ado, here is my conversation with Mr. Michael Oliver. I'm here with Mr. Michael Oliver from Momentum Structural Analysis. Welcome to the show. Thank you very much for taking the call with me. Thanks, Roger, for inviting me. So, look, before we get into the main bits about what we're talking about today, I wanted to ask you, we just saw a U.S. jobs report come out 4.3% unemployment, so lower than what the expectations were. And now we're also seeing some escalations in the war with Iran over the weekend. But I'm just curious, considering this stronger than expected jobs report, which was released, by the way, while the market was closed, combined with this escalation potentially with Iran, another escalation. What do you think this is? How do you think this is going to impact markets when they open up on Monday out of curiosity? Well, we think that, let me put it in perspective. Go back a year and think about the US stock market. It had reached the S&P 500 reach just below 6,200 early in the year.
Thanks, Roger, for inviting me.
Okay, it then rolled over. We called for a down move at that time, and we thought there'd be a bounce point around 4,800. But we didn't know there would be a headline that suddenly surfaces that's fresh and new but negative, and that was tariffs. Okay, tariffs had not been on anybody's mind in the entire bull market since 2009. All of a sudden, tariffs come out, and there's a dark little story. Okay, so people sell, and then at the bottom of that, sell off in April. Trump comes out and says, oh, 90-day pause, and party on again. Market goes up. Okay, it's like a bunch of little puppies chasing cookies. Okay, but it's a trend.
We think that, let me put it in perspective. Go back a year and think about the U.S. stock market. It had reached, the S&P 500 reached just below 6,200 early in the year, January, February. Okay. It then rolled over. We called for a down move at that time, and we thought there'd be a bounce point around 4,800. Well, we didn't know there would be a headline that suddenly surfaces that's fresh and new, but negative, and that was tariffs. Okay. Tariffs had not been on anybody's mind in the entire bull market since 2009. But all of a sudden, tariffs come out, and there's a dark little story. Okay, so people sell. And then at the bottom of that sell-off in April, Trump comes out and says, oh, 90-day pause. Party on again, market goes up. Okay, it's like a bunch of little puppies chasing cookies. Okay, but it's a transitory headline, because if you think about early this year, tariffs were hardly an issue. It wasn't a major focus point anymore. And then suddenly Iran war comes up. Now we have another in-your-face sudden piece of news that has nothing really to do in a major way with the long-term context of what has been happening in the markets and under the surface monetarily. I think this transitory headline, war news, can be interpreted two ways. Some people think, oh, it's bullish for certain things. Well, oil, obviously, in this case, and gold, which it wasn't. Surprised them. But they sold into stocks thinking, oh my gosh, this is a big negative. Well, frankly, MSA is negative about the stock market. We think it is in a process of topping, laborious, since early last year. This headline, I think, is probably going to be like the tariff headline, meaning, yes, it has some importance, but it's likely to be transitory. And then suddenly you're left again with the underlying realities that have to be dealt with, the things that could drive the market down. And I don't remember a market going down with a dark headline signaling the actual top. Usually the dark headline comes a year later, and suddenly you say, oh my gosh, now I understand why it went down. So you asked me about the war. Yes, it has some impact. Pardon me for getting long-winded here, but oil, for example. Oil was back early this year, late last year, in the 55 to 60 zone on WTI crude futures. If you look historically back, that is a cheap level for oil. I mean, it made two peaks in the 140, 150 level in the last 10 years, okay? So being in the 60 level is hardly overdone. We had a technical major breakout signal that occurred in January as price moved up to 63. No war event. February gained some more, no war event. And then suddenly March, we have a war event, and it explodes. Yes, it is positive for oil, but the oil has other things that were driving it, not that headline. And so I think ultimately oil is going higher, but it's not going to go higher because of that Iran situation and the Hormuz closure. Likely that will open at some point. Oil will go higher for basic fundamental reasons underpricing, for example, in relation to other assets and so forth. So again, the war event, I think, is it'll come and it'll go. It's not the main driver.
You're bearish and stayed bearish through 2016. February, we've been bullish on gold since February 2016, and nothing on our long-term momentum trend analysis says that it's over. In fact, the structures on momentum, if you plot them like you would a price chart, you're not even close to structures that could jeopardize the trend. And almost always when gold or any other major market makes a major turn, it doesn't have to travel a long way in price to get to the point of breakage. It will break it pretty soon after making a top or after making a bottom. In this case, there is no major reason for us to reassess gold or sulfur as being negative.
We run momentum studies of all the markets, and we don't do it in a normal way with the wet noodle indicators like RSI and MACD and so forth, things on your screen. We have a different way of looking at it. We look at momentum structurally. We plot lines like price chartists do on price charts, except we plot them on momentum. And we define structures, and quite often momentum, in fact, almost all the time, before a market makes a major trend change, a top or a bottom, the momentum will have signaled that before price tells you the same. Momentum almost always leads. We have been both bearish and bullish on gold over the decades. MSA has been around since 92. I was in the futures side before then, but 92 our research began. For instance, back in 2011, we turned major bearish on gold a couple months after it made its peak at 1920. In January of 2012, we got major bearish and stayed bearish through 2016, February. We've been bullish on gold since February 2016 and nothing on our long-term momentum trend analysis says that it's over. In fact, the structures on momentum, if you plot them like you would a price chart, you're not even close to structures that could jeopardize the trend. And almost always when gold or any other major market makes a major turn, it doesn't have to travel a long way in price to get to the point of breakage. It will break it pretty soon after making a top or after making a bottom. In this case, there is no major reason for us to reassess gold or silver as being negative. This has been a sharp correction. Now, on the commodity issue, good point. Bloomberg Commodity Index turned bullish to us last October. Now, the Bloomberg Commodity Index is a well-balanced index. It contains energy, oil, grains, cotton, sugar, all kinds of things, including monetary metals and base metals. So it's well-balanced. It broke out to positive momentum trend last October, well before any Iranian war. And oil broke out in January before the war. So something was going on in the commodity category that says we're turning up. I argue that probably, and this is not, we don't impose fundamental analysis, but we happen to see it, often coincident with our momentum work, that simply commodities were underpriced for too long, both to their own price history, underpriced, and underpriced to things like the stock market, vastly underpriced. And money flows will change. You know, they'll move out of a stock market when there's a perception, ooh, maybe it's too risky. It moves somewhere else. And I think that's begun. This war simply exacerbated the situation a bit, got a little too excited too quickly. So that's what I see. So yes, I do see something good in the commodity.
Had one coincident with the stock market, which has got everybody burned with that memory of, oh my gosh, if you're right, MSA and the stock market's topping, that must mean gold is topic. No, first off, the stock market is in a laborious top, and I frankly don't think it's going to drop anytime soon. And I think you could get an up month this month, despite the quote dark news. Maybe we'll get some happy news out of Iran and therefore cause a knee-jerk rally in the stock market, which would be typical, much like that tariff 90-day pause caused a rally in April last year. But no, I think that's a good linkage, and I think it is very temporary for the stock market. Yeah. You know, gold, it was just a correction. I think it's over now. By the way, good gold correction. I would tend to agree with you on that as well. And I think a bottom has been put in.
accurate, very astute, in fact. Most people think that, if you get a major stock market decline, gold and silver go down too. And it's not true. Historically, if you go back and archive the charts over the decades, you'll see that no, one of the prime beneficiaries of any major bear stock market is the money moves somewhere else, and it's always gold. Sometimes it's also T-bonds. That looks like a category that may not be an alternative this time. So what does that leave you with? Yeah, I think you're exactly right about that October 2008 event, because even then, if you go back and look at gold from 2001, when it bottomed around 2001 and 2, around $260, it was advanced, it quadrupled in price up to 2008, got up to 1,000. And then in this, actually the September high and early October high of 2008, it reached back up to about 980, near the high again. And only then did it have the sharp drop that everybody thought was the end of the world. What happened then was, yes, the S&P also had a horrible month, but the S&P had already been going down for a full year in a major price decline. And it wasn't until October 2008 that finally you had what you could call a crash, because a 35% drop within a month. Gold at that point, frankly, needed a correction. And it had one coincident with the stock market, which has got everybody burned with that memory of, oh my gosh, if you're right, MSA, and the stock market's topping, that must mean gold is topping. No. First off, the stock market is in a laborious top, and I frankly don't think it's going to drop anytime soon. I think you could get an up month this month, despite the quote dark news. Maybe we'll get some happy news out of Iran and therefore cause a knee-jerk rally in the stock market, which would be typical. Much like that tariff 90-day pause caused a rally in April last year. But no, I think that's a good linkage, and I think it is very temporary. For the stock
So
market, yeah, gold, it was just a correction. I think it's over now, by the way, the gold.
holding its strategic O, apologies for the noise back there. We've got a guy coming through with a cart. So, as I was saying, what about silver in this regard? I suspect, and I've said it in past videos, that the United States is potentially rebuilding its strategic silver stockpile. And again, linking it to the war with Iran, despite the fact that I agree with you that this is noise. I suppose my question here is, and one that people in my Patreon community especially were curious about, is if you think this could potentially accelerate stockpiling of critical minerals like silver. If so, do you think that there are any other investable commodities that could be on the radar for people who are potentially watching this, like copper, which is something else that my viewers are very interested in?
Well, the dollar situation is interesting because too many people make a linkage between trends in the dollar and gold. And let me just state one fact. Right now, the dollar index is around 99. Okay. Recent lows have been down around 96. Okay. If you go back to when gold made its bear market low, which was December of 2015 at 1,040 some odd dollars. Okay. We're quadruple that price now, more than quadrupled. Where was the dollar index then? 97. You're almost where you were a decade, 11 years ago. Gold quadrupled and the dollar has twisted sideways, dollar index. So it's not a good correlation. However, I do see the dollar as having been broken as of March last year. When it dropped through 104, we turned bearish. Since then, it has dropped into the 90s and is laboring mostly below the 100 level recently. I think it is in a negative trend. And I think you could be right that the next obvious drop in the dollar will occur soon. And people will say, oh, it's no longer the world's reserve currency. Why you need one, I don't know anyway. We have the ability today to transfer from one money unit to another instantly. So why you have to have one that is like used to be the British pound was, Anyway, that is changing, and I think it is changing negatively for the dollar. I think you're right on that. And that could help gold. But the real issue for gold, the ongoing degradation in the money unit.
Until late last year. What's going on there? It's a monetary metal. Well, let's assume it made a mistake markets make mistakes. They get overbought and they pay dues on the downside. Or in the case of silver, I'd argue it stayed underpriced for too long. And when markets make mistakes, what do they usually do? They correct the mistake, but quite often they overshoot in an exaggerated way the error they made the other way. So our view is silver's going to see $300 to $500 an ounce, and probably this year, and I wouldn't be shocked to see it by this summer catching up to gold on a relative pricing basis. Right now, silver is like 1.6% of the ounce of gold. Divide one into the other. Heck, 2011, when silver was at $50 back then, it was 3.1% price of gold, more than double its current relative value to gold. And in 1980, it was 12%. It would not shock me to see silver return to those relative performance levels like 3% or 6%. So for those people who follow
Yeah, I think that the monetary metals are leading, and now the commodities have joined them. And it's not always the case. Broadly speaking about commodity, including copper, it flows pretty well, not with gold, but with trends in the Bloomberg Commodity Index. It tends to move in pretty good sync with that, sometimes stronger, sometimes not. But I think the issue of the U.S. stockpile is, yeah, it's peripheral. I don't think it's the core driver of what's going on in monetary metals at all, or silver. Now, silver is a two-faced metal. It is monetary metal. People forget that. It does move with gold. The problem with silver, pricing of silver, is it's vastly historically underpriced. Think about this. Gold, since it got legalized in 75, made a high at 200, then dropped back to 100, then went to 850, then dropped back to 260, then went to 1920. So every time it makes a higher high, it's massively higher than the prior bull market over that 50-year period. Silver was capped at 50, 50, 50. What's going on there? It moves with gold. It goes up with it and down with it, but it stayed capped. You can look back at copper, for example, and go back to the 1980s, 90s, 2000. And in 2005, after decades of range from 50 cents a pound to $1.50, sort of like silver's $4 to 50, $4 to 50 range, it lasted 50 years. Copper broke out of that range in late 2005, early 2006, and on its own, by the way, and it quadrupled in price in a matter of several quarters. Quadrupled on its own without a major commodity upheaval as well, and lived in a new reality after that. Lead did the same thing in 2007. Why didn't silver come out of its 50-year range until late last year? What's going on there? It's a monetary metal. Well, let's assume it made a mistake. Markets make mistakes. They get overbought and they pay dues on the downside. Or in the case of silver, I'd argue, it stayed underpriced for too long. And when markets make mistakes, what do they usually do? They correct the mistake, but quite often they overshoot in an exaggerated way the error they made the other way. So our view is silver's going to see $300 to $500 an ounce, and probably this year, and I wouldn't be shocked to see it by this summer, catching up to gold on a relative pricing basis. Right now, silver's like 1.6% of the ounce of gold. Divide one into the other. It was 3.1% price of gold, more than double its current relative value to gold. And in 1980, it was 6.5%. It would not shock me to see silver return to those relative performance levels, like 3% or 6%.
broken out our weekly momentum silver, which is a fairly intermediate metric. It's
So off the page. Yeah. Getting up to an old reality, and do it quickly. Not take years to do it, but take literally months to correct, much like an inverse crash. Okay. Excess one way begets it the other. I think silver's now engaged in that. And while gold is going to go a lot higher, I think silver's going to go like triple what gold does. And if you think about real dollar terms, what was the quantity of money back in 1980, M2, for example? What was the quantity of money in 2011 when silver was at $50? What is it now? Realizing that M2 increases about 80% quantity of money every decade. Every decade. Okay. Why can't silver not reflecting that? If it did, it would be $300 to $500.
high demand, government stockpiling, and monetary factors. Okay, so let's say by the summertime we get to $3 to $500 an ounce. My question to you is what happens after that? Because you said earlier on that the market tends to overcompensate for things, and I think most of my viewers understand that, and I agree with you completely. So where do we land? What becomes the new norm after $3 to $500 is sold off? I'm going to bet that gold is well above its normal bull market peaks. Now, let's use the mama market first. It's two prior bull markets from the 76 correction low where it dropped back to 100 and then went to 850. That's an eightfold move. Then from 2001 and two, when it had a pullback to 260 area, it had another eightfold move over the next decade to the 2011 peak. If we have another eightfold move, in other words, just do it again, gold to be well over 8,000 because our bear market low is 040 something. Okay, just to replicate what is done twice before. Even JP Morgan recently came out and said they have a fundamental reason for thinking over 9,000. So, okay, imagine that happens.
If the recent correction is over, which we think it is, and by the way, most of it occurred really in a day and a half. January 31st, February the 2nd. The gold collapse and silver collapse did its thing then, and it went into a violent sideways range since. Every time it goes down within that range, people think it's making new lows, and it doesn't. Frankly, we wanted to see, a few weeks ago, we put out a report said, let's see gold take out the Feb low and silver too. And sure enough, they did. And as soon as they took out the February price low, which any idiot with the price chart can see, and he ran from the market naturally. Sell stops were elected. Okay. So, and new shorts, no doubt, got in as well at that point. What happened immediately thereafter was a catapult back to the upside. In other words, they cleansed themselves. And if that was the low, and I think it was, you're back in the middle of that range almost now. And you ever get silver, for example, momentum, our weekly momentum is silver. In fact, I'm preparing the weekend report right now. We've already broken out our weekly momentum silver, which is a fairly intermediate metric. It says, likely you've seen the low and you're turning up. Price has a level that even a price chart guy should notice. Since our high and the collapse in February, there have been 3 rallies on silver that got above 90. And it was sold there and sold there and sold there. Anytime it got above 90, 3 times. You go back a 4th time, back above 90, it's not going to stop this time. The lid's coming off. And I think that will shock people. And again, ask yourself the question. If copper can be trading now just below $6, and it was in multi-decade range at an average price of $1, 1980s, 90s, 2000, 2005, while silver was still capped in the $50 range, below, 4 to 50, 4 to 50. How come copper is trading 5 and 6 times its average price back then? And people can't understand the potential for silver to be trading 5 or 10 times its price it was back then.
And my interpretation of it is, and I'm curious to get your take on it, is that the Fed is already starting to fight with the bond market, the bond vigilantes who are driving the yields on these treasuries up because, of course, they expect more US dollar debasement. They're expecting more inflation around the corner. And the Federal Reserve, instead of, decreasing rates further, as was the plan, which the bond market, by the way, hasn't really fully been participating with. That's right. They're trying to bump those yields on the short end of the curve down to make sure that
I'm going to bet that gold is well above its normal bull market peaks. Now, let's use the mama market first. It's 2 prior bull markets from the 76 correction low where it dropped back to 100 and then went to 850. That's an 8-fold move. Then from 2001 and 2, when it had a pullback to 260 area, it had another 8-fold move over the next decade to the 2011 peak. If we have another 8-fold move, in other words, just do it again, gold to be well over 8,000 because our bear market low was 1,040 something. Okay, just to replicate what is done twice before. Even JP Morgan recently came out and said they have a fundamental reason for thinking over 9,000. So, okay, imagine that happens. Where the heck would silver be at that point? Okay, here's our working assumption. When the stock market completes its top, and it's already in the process of doing that, even though I think we're going to have a rally this month. I think it is a broad topping process. And when it breaks down, we have the largest stock market bubble in US history. It's the oldest, it's the biggest in terms of net gain from bear low to high. It's bigger than the 29 bubble. It's bigger than the 2000 dot-com high bubble. It's bigger than the 2007 real estate mortgage crisis bubble. Far bigger by any way you want to measure it, time and dimension. And you can look at an M2 chart and you can look at a Fed funds rate chart and say, oh, now I know why. It got printed higher. Okay. When it starts to break, you're going to have every data point you want to have go dark. And it usually happens after the stock market is already well off its high. That's when you see all the data points go dark as heck. And you know what the central banks will do. They will go ape. They'll go QE 10, whatever they have to do. And now they have a problem with their bond markets. They didn't have that back in 7. 7 through 9, bonds went up with gold. Yields went down. Bond prices went up with gold. 2000 to 2002, you could have bought bonds or gold and made money while the stock market went down. This time, that's not what's happening. So suddenly you're left with one category. Pardon me for saying it, real money. Okay. I think you're going to transition one country after another out of fiat currencies back into real money again, because there'll be a realization due to pain. Street felt pain. Even government felt pain that, hey, the fiat stuff didn't work. It created nothing but boom bust cycles. And China is already moving in that direction. India is talking about silver in that direction. Uh, you get the point, meaning when silver goes to 3 to 500, it ain't coming back to 50. Yeah, you could have a sharp correction, but it'll be in a new reality.
Last October, November period, gold had been in a range of relative performance readings to the S&P for 10 years, where to go up and down, but really sideways, meaning part of the S&P. So as the S&P went up, gold was going up as much with waves, but still really sideways, but it broke out of that range late last year. And what happened to gold after that? It exploded in price. Silver did the same thing versus the stock market, and so did the gold miners. If you plotted them, they had like a 10-year base of depressed relative performance. They broke out of it. You want to go back to October and see where the price was then of GDX, XAU, SEL, Silver Miners ETF. They've exploded since. And though they've taken a hard break this year from their high, we ran graphs, idiot graphs, I call them, because it simply measures how much was the quarter up in price for gold, silver, gold miners, silver miners, and the S&P from December's close last year to March's close this year, first quarter. Silver was up almost 7%. Gold was up more than 7%.
The bond market is now an issue. In fact, the president of New York Fed, Williams, I think his name, back in mid-November, said the Fed is now going to start buying bonds. And he wasn't pounding the table. He said, oh, it's just to provide liquidity. Okay, yeah, right. Okay, great. So as you notice, the balance sheet is okay. They've been buying bonds, but look what's happened to T-bond futures since then. They were up at 117, 118. Recently, we dropped down on the 112s. Okay, so their buying hasn't helped. It may have slowed the downside or rise in yields that they've been trying to prevent, but it hasn't stopped it. Now, and we've got some technical reasons just using T-bond futures and momentum of T-bond futures that argues the recent drop may have broken the legs of the T-bond market, where it's been sideways since late 2022. High yields, high rates, low price. All the rally efforts in T-bonds since that crash low in October of 2022, when it got down to 117. T-bonds had been above 190 in 2020. They collapsed. It's been sideways. They can't seem to get the bonds off the mat. And that's now a crisis, just like look what the Japanese are doing. Their big panic is not corporate bonds, it's their own. And the new prime minister of Japan, who has postured herself as sort of a reflection of Trump, meaning, she's a conservative type or whatever, she used the phrase, we're going to print, print, print. Well, they're not the only ones with the bond problem. And so Gold and silver, the real money, know that, well, if they're going to have to deal with this crisis, not only commercial credit, which is starting to show as a crisis as well here in the US, and watch the financial sector, which we've been doing, because it technically does not look like the S&P anymore. It looks like it's edging toward the edge of a cliff. Um, they've got that problem, commercial credit, reflected by Bank of America and Visa. Look at their charts, okay? Uh, and they got a T-bond problem. Well, there's only, what do they have to fight it with? Monetary excess. Turn on the hose. Well, what does that do to the degradation of the money unit in terms of its real quantity and its buying power? Degrades it. So the real inflation is not commodity prices going up. It's the decline in the real value of the money unit, the yens, the pounds, the euros, the dollars. They're all competing in degradation. So
somewhere else. They're largely going to move into commodity-based stocks, oil stocks being one category. The only problem with oil right now, we turned bullish in January as oil came up through 63. It got too excited by the war news, and it would not shock me to have a point where some good news comes out. Like, for example, I put out a report a week or so ago suggesting this is a likely possibility, but nobody seems to believe it.
Absolutely. I'm more so than I am on gold. There's been a recent shift. We use spread measurements. What that means is we divide the price of one asset into another, express it as a percent. So, for instance, back last October, November period, gold had been in a range of relative performance readings to the S&P for 10 years, where to go up and down, but really sideways, meaning par to the S&P. So as the S&P went up, gold was going up as much with waves, but still really sideways. But it broke out of that range late last year. And what happened to gold after that? It exploded in price. Silver did the same thing versus the stock market, and so did the gold miners. If you plotted them, they had like a 10-year base of depressed relative performance. They broke out of it. You want to go back to October and see where the price was then of GDX, XAU, SIL, Silver Miners ETF. Have exploded since. And though they've taken a hard break this year from their high, we ran graphs, idiot graphs, I call them, because it simply measures how much was the quarter up in price for gold, silver, gold miners, silver miners, and the S&P from December's close last year to March's close this year, the first quarter. Silver was up almost 7%. Gold was up more than 7%. Not bad for a quarter, right? Okay. GDX was up more than gold by a bit. And the best performer of all four was SIL. Hard to believe, you look at the chart, but it was actually up more net price gain on the year. And the S&P was down the opposite amount, about 6-7%. So when people think the miners will go down with the stock market, well, from December last year to March of this year, the miners are up 7-8%, and S&P's down that much. So that correlation doesn't make much sense. Also, if you go back to the date you mentioned, the 2008 October event, back then gold had a puke along with the stock market. So did the miners. However, at that point in time, on a relative performance basis, when you plotted the miners, so I used XAU index back then because it existed, and plot it versus gold or the S&P, it was in negative performance trend mode, meaning it should have gone down more and suffered more than gold did, for example, back then. The opposite is the case now. When I run relative performance of miners versus gold, they've shifted to outperform. And I run miners versus the S&P, they've shifted to outperform. So the total opposite condition exists now, meaning I favor the miners.
Thank you so much for taking the time to join me here. And, you really saved my butt this week, because otherwise I was going to have to be stuck in this hotel room for 2 or 3 days making a video. But this was a great conversation, and I know my viewers are going to absolutely love it.
Like
so
you were able to
thank you again for joining me, and hopefully we can do it again sometime. Yeah, Roger, thank you much. Thank you to everyone who watched that discussion with Mr. Michael Oliver. I hope you sincerely enjoyed it. Please leave a like below if you did. And for those of you who would like to see me live and have a chat with me, please remember that I will be appearing at Metalverse 5.0 in Warsaw, Poland on. See some of you there. Have a great week ahead. Remember to take care of yourselves and take care of each other. See you in the next video. Goodbye.